Hello everyone, we're going to look at Unit 5 which talks about financial statements. Our learning objectives are 1. Shall be able to explain the meaning of financial statements. 2. We shall identify the various financial statements. Shall also calculate the gross profit or loss. And lastly, should be able to appreciate the need for the end of period report while we prepare these financial statements. Financial statements are reports prepared by a company's management to present the financial performance and position at a point of time. Why do we prepare financial statements? 1. To determine the ability of a business to generate cash and the sources, and at the same time, uses of that cash. 2. It helps us to determine whether a business has the capability to pay back its debts. When we prepare like the balance sheet, it is going to help us know whether your business is able to pay back its debts. 3. To track financial results on a trend line to spot any looming profitability issues. Tracking financial results, that means when we are preparing like the income statement, we're able to see whether we're making some profits and then what we spend on, and from that we're able to say either we reduce some of the expenses and get more profits. 4. To derive financial ratios from the statements that can indicate the condition of the business. In the previous videos, we talked about financial ratios, so you know better. Lastly, to investigate the details of certain business transactions as outlined in the disclosures that accompany the statements. If some of you have been reading newspapers or journals, you will find that there are some companies that always disclose of their business transactions. They prepare maybe a balance sheet or an income statement, then the public are able to see how that business is doing. So these are some of the importances as to why we should prepare the financial statements. Types of financial statements. Do you know any? I've already talked about some. There are 4 main types of financial statements. 1. The income statement, balance sheet, cash flow statements, and then the statement of owner's equity. So as an accountant, as an entrepreneur, you should know that we have 4 main financial statements of which we need to know how to prepare them and what's their importance. Shall start with the first one, which is the income statement. The income statement is a financial statement that reports a company's financial performance over a specific accounting period. A statement or a document that is going to show the company or the business performance when it comes to finance over a given trading period, usually at the end of the year. Financial performance is assessed by giving a summary of how your business incurs its revenues and expenses through both operating and non-operating activities. Here, after extracting a trial balance, the next step is to determine the amount of profit that the business has made during the trading period. This is done by preparing 2 accounts, namely 1. The trading account. It is prepared to determine the value of the gross profit or gross loss by deducting the cost of goods sold from the net sales. So how do we get the gross profit? Gross profit is equal to our net sales minus the cost of sales. Whenever the net sales are greater than the cost of sales in your business, you get a gross profit. And vice versa. Vice versa meaning, how do we get a gross loss? It's the cost of goods sold minus the net sales. That means cost of goods sold or cost of sales are greater than what we are to sell. So then we shall have a loss. What are some of the items that we find in a trading account? Whenever we're preparing a trading account, there are some items that we need to record. 1. Sales refers to the value of goods which were bought for resale and have been sold by the business. It is revenue earned from goods sold. They are entered into a trading account for the purpose of calculating the gross profit or loss. 2. Sales returns. Value of goods that were previously sold but have been returned to the business. Sometimes you sell some goods and at the end of the day you find some of your customers or clients bringing back some of them. Why would they bring some of their goods, your goods back? Maybe they're expired, not what they wanted, like that. Net sales, we said here we shall get sales minus the return inwards. It's also called sales returns. The goods that they have brought us back, so we need to know how much we have sold. Then opening stock. This is the unsold goods in the business available at the beginning of a new trading period. Another item of purchases, and we're saying these are goods bought by the business for the sale. Then we also have purchases returns. Goods previously bought by the business for sale but have been sent back to the suppliers. That is, shall get the net purchases, which is purchases minus the returns outwards, also called purchases returns. So this time it's us. We, the business, we purchase some goods from a given supplier. After bringing those goods to our shop, we find maybe some are fake, some are expired. Then we're supposed to take them back. All others have defects. Carriage inwards refers to the cost of transporting these goods or bring the goods up to the premises. So assume you buy goods from Kigali and you're based in Yamata. So you need to buy those goods and then incur transport to bring them to your shop in Yamata. The cost of transporting those goods is what we call as carriage inwards. So we shall also record it in our trading account. Then another item that you need to know is wages. And we're saying these are payments made directly for purchases activity. Only wages paid directly for purchases in a trading account to determine the gross profit or gross loss. That is, shall get our net purchases, which is equal to the purchases plus the carriage inwards plus the wages minus the purchases returns. I want you to take note. Sometimes in the question they might give you salaries and wages. So that one is an indirect expense. We are not going to record it under our trading account. But if it's wages alone, it means, again, using the same example of buying goods from Kigali, you need someone, the Bakalani or casual workers, to load those goods onto the vehicle, and you're going to pay them there and then directly. So that's why we add them onto the purchases, plus the transport costs we have incurred, and then we subtract what we have returned back to get our net purchases. Then closing stock, as you hear in closing stock, these are goods not sold by the business after the end of a trading period. It is subtracted from the goods available for sale to get the cost of sales. And then the cost of goods sold, we shall get COGAS, which means cost of goods available for sale minus the purchases returns. Simple. Drawings or drawing of goods. Sometimes an entrepreneur may take physical items out of the business for private use. This must be subtracted from the goods available for sale in a trading account. And B, only drawings in form of goods must be treated in the trading account. So again here in the question they might give you drawings, and then that one you take it to the balance sheet. But if they say drawing of goods, you have withdrawn some goods for your personal use, so you need also to credit. Then net purchases is equal to purchases plus carriage inwards plus wages minus purchases returns minus again the drawing of goods that you withdraw from your business. Hence, the cost of goods available for sale is equal to opening stock plus our net purchases. Gross profit is the excess of the net sales over the cost of goods sold or cost of sales. It also refers to the total profit obtained by an enterprise before paying off other operating expenses such as electricity, such as water bills, such as salaries for the workers, those operating expenses. Thus, gross profit is equal to our net sales minus the cost of sales. And then how do we incur gross loss? This is the excess of the cost of sales over the net sales of the business. So our gross loss is equal to the cost of sales minus the net sales. So let's look at one example of getting a gross profit. The trading account is prepared by a business to show how much gross profit has been made for the financial period. We've already talked about that. So GP is equal to sales minus the cost of sales. And cost of sales is equal to opening stock plus purchases minus closing stock. For instance, in a given sales of 50,000, purchases 20,000, opening stock 10,000, so we are going to get our opening stock plus the purchases, which is 30,000, minus the closing stock of 5,000. We remain with 25,000, which is the cost of sales, and then 50, which is our sales minus the cost of sales. That's how we get our gross profit. Example, when we have returns, so we shall have sales 40,000, then we also have some returns inwards. So they return some goods to us, which is 40 minus 5, which is 35,000. Then we get opening stock plus purchases, we come to 27,000. Then we also have these returns, which are purchases returns of 3,000, remain with 24,000 minus the closing stock of 4,000, and you come to your cost of sales, which is 20,000. So, which I get 35 minus 20, then we get our gross profit of 15,000. I think that is that. Thank you for watching.